New listings across the GTA just fell almost 18%, and the market is still in buyer's territory. That combination shouldn't happen, and what it tells us is more interesting than any headline you'll read today. Everyone's about to tell you Midtown Toronto went up this month. Every single property type in Midtown actually went down. Let me show you. If you own a home in Midtown Toronto, Bedford Park, Lawrence Park, Forest Hill, you may hear this month that our area was the one bright spot, that the benchmark price here is up slightly while the rest of the GTA is down. I want to walk you through why that number is a little misleading, because I'd rather you have the truth than a flattering headline. The composite benchmark for Midtown does read up about 1/3% year over year. But when you actually open it up, every single property type underneath it is down. Detached down 1%, attached homes down almost 5%, townhouses and apartments down 6%. There are some genuinely positive signals in our neighborhood this month, and I'll show you those too, but the headline isn't one of them. I'm Anthony Malfara, your local real estate broker, and here's the honest July read on Midtown Toronto. Inside the city of Toronto, there were 2,242 sales, new listings at 4,980, active listings at 9,310. Average price just over $1 million at $1,010,000. The city is holding just above $1 million on average, though like the broader GTA, that's a lower number than a year ago. Now, the sales to new listings trend for the city is 38.1, marginally above the GTA's 37.1. So the city is a touch tighter than the region, but still in buyer's market territory. Months of inventory at 4.6, same as the GTA, and the sales to new list ratio is 97%. So city sellers are accepting 3% below asking on average, slightly worse than the GTA's 98%. Average days on market is 32. Now, one local exception worth flagging: Toronto's East End sales to list ratio is at 101, meaning homes there are transacting slightly above asking on average, which means they're either getting in multiple offers or getting slightly above ask. If you're a buyer who has been looking east because you assumed it was, better value, understand that, competition there is real right now. Now, Midtown Toronto, Bedford Park, Lawrence Park, Forest Hill, those areas. The first caveat that matters, 70 homes sold in Midtown in July. 70. Now, at that volume, a handful of unusual sales moves the average significantly. So I'm going to give you the numbers, but treat any single month here as a data point, not really a trend. There's not enough, volume to really create a trend here. So the count: 70 sales, 118 new listings, 213 active listings, months of inventory was at 3.9. And that one is genuinely favorable. The GTA is 4.6. The city is 4.6. So Midtown is 3.9. Less supply relative to demand here than in the broader areas. That's real, and it's the strongest thing in Midtown's column this month, I would say. Sales to new listings trend was 39.9, right at that line between a buyer's market and a balanced market. Now, prices, and this is where I need you to pay attention. The MLS HPI, composite benchmark for Midtown is 1,922,600, which reads up 0.33, 1/3% year over year. And you might hear that number quoted. It makes our neighborhood look like the only place in the GTA holding value. Single family detached benchmark 2.475, 500, down 1% year over year. Single family attached 1,443,000, down 4.97%. Townhomes and apartments 659,000, down 6.07%. All three down. Every property type in Midtown is worth less than it was a year ago on this measure. So a composite that reads positive while all of its components read negative is a function of how the index weights those components. It's not necessarily appreciation. I'm not going to stand here and tell you that Midtown went up when the details kind of say every segment went down. On actual transactions, the average sale price in Midtown was $1,884,074. The median $1,540,500, and that's a gap of over $300,000, which tells you a small number of high-end sales pulled up the average. The median is the better read on a typical home, so use that number. Detached homes, 40 sales Average 2,435,000. The median 2.3 and change. Sales to list 95%. Days on markets 35. Condo apartments, there were 23 sales. The average was 1,153,000. Sale to new list was 94%. Days on market was 39. And note, 23 sales is a small enough sample that I would not draw conclusions from the condo average here at all. Two more figures, and they don't flatter us. Midtown sales to list ratio is 95% versus 97% for the city. Sellers here are accepting deeper discounts off of asking than the city average. And average days on market in Midtown is 36 versus 32 for the city. So Midtown is now taking longer to sell than the city overall. In June, it was faster. Now, I know from living here that in Midtown in July and August, people are on vacation at their cottages. So, to me, the longer days on market, that kind of data could just read into the fact that in our area, people are on vacation out of town more so than they are citywide. That's just my own kind of quick take on that data point. So the honest Midtown summary, inventory is genuinely tighter here, which is a real structural advantage, but properties are taking longer to sell. Again, could be for a various number of reasons. Sellers are accepting bigger discounts, and every property type is down year over year on the benchmark. Not a ton, but down. The headline composite number is the weakest evidence in the set, not the strongest. So let's talk about what this data actually implies, and I want to give you both directions honestly because the data supports both. Let's start with the macro picture, and I'm pulling this from Bank of Canada and Stats Canada, not from the real estate board. So the Bank of Canada overnight rate is 2.3%, which held flat. Prime is 4.5%. Mortgage rates as reported, 1 year fixed around 5.49, 3 years around 605, 5 year fixed around 609. Now these are the posted rates. You can obviously get better rates at the bank. Notice something there. The overnight rate is 2.3, but the 5 year fixed mortgages are above 6%. So fixed mortgage rates aren't set by the Bank of Canada. We've talked about this before. They're driven by bond yields. So if you're waiting for the bank to cut and assuming your mortgage gets cheaper, that link is weaker than most people think. Watch the 5-year Government of Canada bond yield if you want to anticipate fixed rates. Now, Toronto's unemployment came down to 7.2 in June from 7.6, and employment grew 0.9%. That's improvement, and it's real, but 7.2 is still an elevated unemployment rate by historical standards. Improving from weak is not the same as something being strong. GDP in the first quarter of 2026 was just negative 0.1%, still slightly contracting. Inflation in June, 2.8%, down from 3.2, below 3%, but still above the bank's 2% target. So an economy healing from a soft patch, not a booming one. Now, the two scenarios. The case that prices firm from here. So supply has genuinely contracted, inventory is falling, employment is improving, and inflation is easing, which supports household confidence. Sales and listings are leading indicators. They move before prices do, typically by 3 to 6 months. So if demand picks up even modestly against this reduced supply, the math pushes prices up. What would confirm it? The sales to new listings trend moving above 40% and staying there, longer than a month. Days on market shortening and the sale to list ratio moving back towards 100%. That would kind of firm things up from a forward trend. The case that prices stay flat or drift lower, that 17.8% drop in new listings may not be a supply shortage. It may be discouraged sellers. People who tried to sell didn't get their price and withdrew. That's latent supply. It comes straight back the moment prices show any firmness, which could mean a recovery. And here's the telling part. Despite listings falling almost 18%, the market is still in buyer's territory at 37.1%. If demand were solid, a supply cut that large should have pushed us comfortably into balanced or better. It didn't. The gap between how much supply left and how little the market tightened is a demand signal, and it's not a strong one. The 13-day spread between list date and property date days on market points the same way. What would confirm this scenario, if new listings, rebounding sharply in September and October, active inventory climbing again, sale to list ratios staying below 97%. Guess what? I don't know which one happens. Anyone who tells you they do is selling something. Chubb, for its part, projects a stronger second half. That's their published forecast. And it's worth knowing that that's their view. But July's data doesn't obviously confirm it yet. What I'd watch over the next 60 days, the September new listings number, and whether the sales to new listings trend crosses 40%. Those two together will tell you which scenario is playing out well before prices do. And guess what? I'll be sharing that with you in the next few months anyway, so you don't need to go searching for it. So for buyers, you are in a buyer's market by the standard measure, 37.1 sales to new listings, 4.6 months of inventory, sellers accepting 2 to 3% below asking on average, and prices down mid-single digits from a year ago. That is real negotiating leverage, and you should use it. Where it's tightening, inventory is falling, and in Midtown, it's tighter than the city at 3.9 months. So the supply of options is narrowing, even though your pricing leverage is still there. So from a practicality standpoint, if you find the right property, the data supports negotiating firmly on price and on conditions. The relisting activity in the numbers tells you a meaningful share of sellers on market have already failed to sell once. That's useful information at the negotiating table. On timing, I'll be straight with you rather than kind of pushing urgency. If the firming scenario plays out, waiting costs you. If the latent supply scenario plays out, waiting is fine and possibly better. No one can really tell you which one it'll be. What I'd say is buy when you find something that works for your life and your finances, and negotiate hard when you do, because right now the numbers are letting you do that. On financing, don't assume Bank of Canada cuts translate into cheaper fixed mortgages. Get a rate hold, and if you're comparing fixed and variable, have that conversation with a broker specifically about where bond yields are heading. That's what you want to watch for. If you're a seller, I'm going to give you the real version. Prices are down between 4 and 5% year over year, depending on the measure, and every property type is down. If you're benchmarking your expectations against what your neighbor got in 2025, you should adjust. That's the starting point for an honest conversation. Here's what's genuinely in your favor. New listings fell 17.8%. Your competition on market is materially thinner than it was a year ago. In Midtown, inventory is at 3.9 months versus 4.6 citywide. If your property is well prepared and correctly priced, you are competing against fewer alternatives than at almost any point in the last 2 years. So your competition is less. Here's what's working against you. Buyers have leverage and they know it. Sale to new list, 98% across GTA, 97 in the city, 95 in Midtown. You can expect to negotiate. Days on market are 32 to 36, depending on where you are. And the gap between list date and property date days on market tells you a lot of sellers are relisting because they priced wrong the first time. Overpricing in this market doesn't cost you a few weeks. It costs you the momentum of a fresh listing, and you get a worse outcome second time around. That's what we've normally seen. So the strategy is pretty straightforward. Price it to the current market, not to last year's, and not to what you hope. Presentation matters more when buyers have options. Get the pricing right on day one. On timing, if you need to sell, the thinner competition is a genuine advantage right now, and I wouldn't wait for a better market that may not come. If you don't need to sell and you're not in a hurry, holding is a defensible choice. But understand you'd be betting on the firming scenario that I talked about, and the data doesn't guarantee that. Obviously, that's a decision about your own circumstances, not a market call. And I'm happy to walk you through it with you specifically. So the honest Midtown picture from July Inventory here is tighter than the city, which is a real advantage, but homes are taking longer to sell than the city average. Sellers are accepting slightly deeper discounts, and every property type is down year over year on the benchmark, regardless of what the headline composite number says. Now, granted, they're not all down a lot, so take that as you may. If you own in Bedford Park, Lawrence Park, Forest Hill, Midtown, and you want to know what your specific home is worth in this market, not the average, not the benchmark, your actual house, reach out. I'll give you the same straight read I just gave you here. I live in the neighborhood. I'm in this neighborhood every day. DMs are open. Link in bio. Thanks. I'll see you next month.